love the channel and find it useful in becoming a happy retiree. Subscribe today. One of the areas that has been a frustrating area for investors for a while and happened to pop under the cover of Barron's this week. You see a big picture of ExxonMobil, because Exxon is emblematic of what I wanted to talk about for a couple of weeks here. And that is this giant story going on between the price of oil companies and the price of a barrel of oil. Over time, they typically move in a pretty similar direction. And when they diverge from each other, meaning that one kind of goes up and does well, and the other does not so well, they meet somewhere in the middle, and those lines reconverge. And I want to go through that today because I think it's an important story for investors to really take a look at. So we're going to kind of zoom into. We started talking about this last Sunday, and we didn't really get to it, but I'm a big believer in understanding the macroeconomic picture. I studied economics at the University of North Carolina. My favorite classes or discipline probably dealt with the kind of macro views, whether it's U.S., labor economics, international economics. But microeconomics, to some extent, zooms in more and is perhaps a more specific science and studies the implications of how individuals interact. So human interaction, individual behavior, individual companies, why and how they behave, and how consumers make decisions. In investing, when you zoom in on specific companies and specific sectors, I think it really helps, or at least can provide the best examples of either an opportunity, and I think that's what we're talking about here today when we talk about energy, or really understanding real value within a particular company or in a sector. In investing, there's almost never a time when all stocks are undervalued. On the contrary, never a time when all stocks are overvalued, right? There's always some sort of opportunity. So you can't say that all stocks are overvalued, and you can never say all stocks are undervalued. Even in 1999, when the overall stock market as a whole traded at 30 plus times earnings, there were companies and there were sectors that were not caught up in that wave of inflated tech hype, as you may remember in the late 1980s. Example, if you look at February of 2000 to August of 2001, when kind of the general market fell apart, and particularly the NASDAQ, tech-heavy NASDAQ, QQQ, if you look at a chart, you'll see that the NASDAQ dropped almost 60%, 60, during this period of time, February of 2000 to August of 2001. The NASDAQ dropped 57%. XLE, which is a great proxy, and we're going to talk about XLE today. It's effectively an ETF. It's basically an ETF that holds a couple of dozen large energy companies. So it's a really good proxy for the energy market. But during that period of time, NASDAQ down almost 60%, energy, XLE, up 9%. So there are always areas that are getting bubble-like valuation. And on the other hand, always areas that are unfairly undervalued or overly discounted. And I wanted to talk about some of those potential areas today. The ones that are getting punished. And maybe they're due for some love, or maybe they're due, or maybe that this has been overdone and they've gotten shunned by markets. And that's a big part of what the article today or this weekend in Barron's was about. I'm going to talk about the sector more broadly, but we're going to zoom in and we're going to start with an entire sector that has fallen well below where it normally trades. And that sector is energy. We talked a lot about in the last couple of months about the energy pipeline area. That's even, let's say, more specific. Those are MLPs, master limited partnerships, the pipeline companies, and energy storage companies. That niche sector has gotten some religion. They've cleaned up how they do business, and they've improved how they operate. And they're still getting shunned by the market to some extent. The story, though, for the broader energy sector, which of course is a massive part of the economy, is that same story is kind of still casting a shadow over the whole energy sector. If you go back 19, 20 years or so, If you look at a chart of the price of oil, and when I say price of oil, I'm looking just WTI, West Texas Intermediate crude oil per barrel, which today is around $69, $70 a barrel. So if you look at the price of the energy index, stocks that make up the energy index relative to the S&P 500. So if you chart performance, you will see a 90% correlation, 89% to be exact, between the two. And again, I'll repeat this for clarity. There's a very high correlation between the price of oil going up or down and how oil stocks do relative to the market. And this kind of makes sense. And here's what this means is that if you looked at a chart of those two lines, so imagine the blue line is the price of oil and the red line is the price of how oil stocks do relative to the rest of the market. Do they do better or worse than the market? And those are two separate lines on a chart. They work in almost perfect unison over time, most of the time. That's this 90% correlation to the two. So what it means is you have two lines on this chart. Think of one visually as the blue line and one as the red line. They track each other very closely. And in cases where they diverge, they quickly come back together. If you're looking at a chart, you see the red line and the blue line. Again, think of the blue line as the price of a barrel of oil, WTI, West Texas Intermediate. You'll see that as oil rises, so will energy-related companies, shares of companies, relative to the rest of the market. So when the price of oil drops, so will the price of energy shares in almost perfect unison. And then there's times when they diverge. So we're going to go and look at 2008, 2013, 2014. What happens next? Well, in every case that prices spread out, or those two lines on the chart that should be moving basically together, anytime they move in opposite directions, one heads higher, one heads lower, at some point on the chart, they always have, at least historically, reconverged. They always come back together. Either the price of oil ends up moving down to meet the price of stocks. So imagine the price of oil goes on a run higher, but energy company prices don't do a whole lot and kind of stay stuck in the mud. Well, oil prices come back down to meet that. Or the price of oil stocks has moved higher to match the price of a barrel of oil. And that is this relationship that is kind of flashing some big signals today. And the topic of at least part of Money Matters here on a Sunday morning. Obviously, the prices of these two are different in absolute terms. So it's not. So this is a chart with two axes, right? So the movement of the two items is not the actual price of the items is not necessarily what we're looking at here. We're looking at the movement of these two lines moving together, not the specific price of each one of these entities. So you have two different axes, if you will, on a chart. And by the way, when we talk about the energy index, what's in it? What are the companies that comprise it? Well, if you go to XLE, which is that's the three symbol. That's the symbol of the Energy Select Spider ETF, symbol XLE. Well, what's inside? If you open up the hood, there are 31 holdings. And as you can imagine, it's a lot of the big energy companies. Some of these you'll know the names, some maybe not, but Exxon, right? Chevron, Schlumberger, ConocoPhillips, EOG Resources, Occidental Petroleum, Valero, Anadarko. And some of these are big integrated oil companies. Some are in the oil service business. Some are, think of Schlumberger making parts to put together oil wells and support oil wells. Some are in the drilling business. Some are in the refining business, like Valero. And then some just do it all. ExxonMobil is in that camp. They might drill for oil. They pull oil out of the ground. They ship oil. They refine oil. And that's what when we say integrated oil companies, it's really the big companies that do all the pieces of the energy life cycle, if you will, from getting it out of the ground until you put refined gasoline actually in your car. But as a group, you put all these 31 companies together as a basket. It usually, and this is the key here, usually moves in lockstep with the price of oil. And when it doesn't, at some point, they reconverge. And as you can imagine why we're talking about that, we're having one of those moments today. We're seeing a big difference between those two lines, the red line and the blue line. And the question is for investors, when will they come back together? And we're going to try to examine that here on Money Matters. I don't know, is this an exciting topic for Sunday morning? Maybe it is. I'm getting excited about it. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.